someone who's pricing like long-term interest rates, you're not looking at one Fed meeting. You're looking at what are rates going to do over the period of a loan that might be 30 years. And in that sort of lowering capacity the Fed's in right now, how fast is that going to happen?
It's fall again, and y'all, it is getting entertaining out there. I hope you grabbed your pumpkin spice latte. We have a lot to talk about. So, like always, we have a couple of key things that we're going to talk about today. What are those three things we're going to discuss?
So first off, like always, we'll go through the recently released existing home sales figures and talk about what sales and prices did. Secondly, big Fed announcement, a lot of news there. We'll get into that and like what it means for our industry. And then lastly, I believe you have some pointers on what people can be doing right now to take advantage of the changes.
Starting with those housing numbers, what did that look like last month?
So sales were down about 4% from last year. It was most pronounced in the Midwest and the South. In terms of prices, so things are slowing down there, which is good news. We had seen some acceleration in home prices early in the year. That's starting to slow down a bit now, which for affordability purposes is going to be helpful, combined with the downward trend that's showing up in mortgage rates.
Sure. That's always great news. And like you've mentioned so many times, that is pretty regional, right? As far as where prices are going up or where they're not going up anymore.
That's the other thing that's happening is the Northeast is actually up 7.7%.
Wow. So it means to me as a real estate professional that I should be having very serious conversations with my clients about when is the right time for them? What makes the most sense, especially in these regional situations where if I'm in the Northeast, it sounds like inventory is still low there, prices are still going up like crazy. These mortgage rate changes might not have any effect on me yet.
Yeah, I mean, at a minimum, with all the news that's coming out of the last couple of weeks, it's a great time to reach out and have a conversation with the client, right? Because everyone has questions right now.
Yeah. Speaking of questions, I have a lot of questions about what just happened with the Fed, because that was a significant change in direction for the Fed, at least for the last few years. But it didn't really do a whole lot to mortgage rates. Talk to us about that.
Yeah, so just to start with like recapping the news, right? We went into last week, the market expectation was for the Fed to reduce the federal funds rate by 1/4 point, or 25 basis points, we like to say.
Sure.
There was some outside expectation it might be bigger than that, but it was considered pretty unlikely. Come the meeting and the announcement, they did in fact lower the rates by an entire 1/2 point, or 50 basis points.
Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a 1/2 percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%.
It said a couple of things. Number one, that the Fed felt like they wanted to kind of like start their monetary easing cycle, as we call it, the trend of decreasing rates, with a strong start. And it also maybe meant that there was maybe a little bit more concern about the labor market than we initially anticipated. But like you said, we didn't see long-term rates or mortgage rates come down in an equal amount, right?
Right.
Ahead of any Fed meeting, there's expectations about what the Fed's going to do. The market does what we call pricing that in already. They've already made moves. Markets anticipate what the Fed's going to do, and they buy and sell things to basically get the rates on various things in line with what they would be after the movement. Someone who's pricing like long-term interest rates, you're not looking at one Fed meeting. You're looking at what are rates going to do over the period of a loan that might be 30 years. And in that sort of lowering capacity the Fed's in right now, how fast is that going to happen? Well, even though the Fed decreased rates more than expected on the first meeting, what they indicated was that in the next 2 meetings they have this year, they were actually going to decrease rates by less than what was initially expected.
That we're going to be making decisions meeting by meeting based on the incoming data, the evolving outlook, the balance of risks. If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low, to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time.
So the good news is that they've started the process. That sort of solidifies the fact that rates are going to go down.
Which is good news.
The bad news is they might not go as down quite as fast as initially expected now that they have started. But again, there's a ton of uncertainty here. While the Fed is, they've basically, all the members of the committee voted where they think rates will be in the next meeting and the meeting after that. That doesn't mean that it's a predetermined path for those rates. So depending on the news that comes out between now and then, they could go down more, they could go down less. There's a couple of different scenarios that could play out. It just means in the meantime, markets have to react to their expectations, and their expectations didn't lead to a place that would cause longer term rates to move downward rapidly.
Gotcha.
Most likely what we're going to see is just a continued slow downward trend, and then some reactions to future meetings depending on what they indicate their expectations are.
So what I hear you saying then is we're still on this slow path.
Yeah, so it's good news for consumers. It's good news for the economy as a whole, because it means, two big things. Number one, people's borrowing rates in general are going to start going down. They'll be able to spend more money, keep the economy growing.
That's good news.
Secondly, it means the Fed's very confident that inflation's back in check, and we don't have to worry as much about prices increasing as we go forward. And it gives the Fed room to do things like continue lowering rates to make sure that the economy stays at full employment and everyone has jobs.
I keep seeing that come up, Ruben, is that this rate change was really all about that, more than it was about mortgages or anything. In fact, Jerome Powell even said, we don't have a lot of control over the housing market, right?
Yeah, he got asked directly, what does this mean for mortgage rates? And he essentially said, we don't have a lot of, mortgage rates and prices, because the question I think was framed around affordability.
Some of your colleagues have expressed concern that with starting to cut rates, you could reignite demand in housing and see prices go up even more. What's the likelihood of that, and how would you react to that?
So the housing market, it's hard to game that out. The housing market is in part frozen because of lock-in with low rates. People don't want to sell their home, so because they have a very low mortgage, it'd be quite expensive to refinance. As rates come down, people will start to move more, and that's probably beginning to happen already. But remember, when that happens, you've got a seller, but you've also got a new buyer in many cases. So it's not obvious how much additional demand that would make. I mean, the real issue with housing is that we have had and are on track to continue to have not enough housing. And so it's going to be challenging. It's hard to to zone lots that are in places where people want to live. It's all of the aspects of housing are more and more difficult. And, where are we going to get the supply? And this is not something that the Fed can really fix. But I think as we normalize rates, you'll see the housing market normalize. And I mean, ultimately, by getting inflation broadly down and getting those rates normalized and getting the housing cycle normalized, that's the best thing we can do for householders. And then the supply question will have to be dealt with by the market and also by government.
Secondly, he even, I think, had another quote where he talked about the fact that they don't impact directly long-term rates. There's a lot of other factors aside from the federal funds rate that go into that, which is kind of what we were talking about earlier.
Mortgage rates have already been dropping in anticipation of this announcement. How much more should borrowers expect those rates to drop over the next year?
Very hard for me to say. That's from our standpoint. I can't really speak to mortgage rates. I will say, that'll depend on how the economy evolves. Our intention, though, is we think that our policy was appropriately restrictive. We think that it's time to begin the process of recalibrating it to a level that's more neutral rather than restrictive. We expect that process to take some time, as you can see in the projections that we released today. And if things work out according to that forecast, other rates in the economy will come down as well. However, the rate at which those things happen will really depend on how the economy performs. We can't look a year ahead and know what the economy is going to be doing.
What I hear overall, and I just want to make sure that our consumers and our real estate professionals who are watching get this right too, is that this is not an indication of dropping mortgage rates. So let's just all be clear on that. This is an indication that we're going in the direction that they said that we were going in, and rates are going to drop over time, likely, but not anything crazy.
I think that's really the story here, is none of this is going to happen overnight.
Right.
We're not going to go from a high interest rate environment back to 3% mortgage rates in a day. We're starting a process is essentially what's happening, where the Fed is going to be incrementally lowering their rates. That's going to put downward pressure eventually on long-term rates, but it's going to take time to work through the system. And there's other outside factors that are going to influence that, since it does have to happen over such a long period of time.
So what I also think is good for us to share with our consumers who are watching and our real estate professionals who are watching is there are still things that you can do today to get ahead of all this, right?
That's exactly right. And, what are those things you think? I'm obviously savings would be a big one.
Savings is a huge one, right? Obviously, we want people to save for a bigger down payment because a bigger down payment allows you to have a lower mortgage rate. Whatever that rate is and whatever the cost of the home is, the more money down, the better that opportunity. The second one is to boost their credit rating, right? And for our consumers right now who have revolving debt and they can have this opportunity to get lower interest rates and maybe pay that off a little faster, that could help increase their credit score too, right?
Yeah.
Another thing they can do is really look out for what is that debt to income ratio they currently carry. So do I want to buy a car right now or should I wait till after I buy a house? What's my debt to income ratio today based on the kind of home I'd like to purchase and what my mortgage rate might look like? I can control that as a consumer if I go talk to a lender or a professional in the mortgage industry and understand that number, right?
Yeah, and from what I'm hearing you say, where you're like all of this together really is start making a plan, right? If you want to purchase a house in the next couple of years, rates are starting to go down. Start putting your ducks in a row so that when the time comes and that rate hits your magic number for what you can afford, you're ready to go.
So the last two things, right, are really to research loan programs and make sure that you're comparing apples to apples when you look at your interest rate, because interest rates change every single day based on the market, based on the treasury yield. Like so many factors really play into our mortgage rates that I think some of us don't give enough credit to.
Yeah, I mean, once people are close, getting that pre-approval and starting that process of figuring out what your rate's going to be is really helpful and important when you start getting into the home search process.
Absolutely. So let's be cognizant of what we can do right now and control our own future that way.
Yeah, exactly.
Well, just like always, don't forget to hit that subscribe now so you don't miss a minute of what we'll talk about next as we continue to watch what's unfolding with those interest rate changes and the market changes. I get to sit every single month with Ruben and talk about it, and we hope to see you back again next month.